Josh Brown, regional banks are weak, real estate's weak for obvious reasons. If rates are rising, you would figure that the pressure points are going to be there. But a day after the Fed chair, what are you feeling today?
I think the big thing is rates, and really talking about anything else is really like an afterthought at this point. This is what markets are keying off. I want to give you some data here. We looked at the SPY and the Barclays aggregate. We're using AGG, the ETF. They're currently correlated at 0.4, which is extraordinarily high. It's been rising for the last rolling 90 days. And just to give you some sense of historically how high that is, if you think about the last 30 years, that correlation has actually been negative 0.31, meaning not correlated at all. What that means is that the bad days for the stock market are the days in which rates are rising, and then when those days reverse, typically you'll see a bounce in stocks. Not happening yet today. You have a little bit of a bond rally underway, but stocks are still weak. But I think that if you want to know what's the market going to do today, just pull up the futures on the 5 to 7 year or the 7 to 10 year, and that'll pretty much give you the script of how things are going to go. We are just being tugged around by that rate situation. I don't see it changing anytime soon. And of course, there's good reason. You're at 8% mortgage rates. The housing market is frozen solid. We are seeing the lowest transaction volume levels since the great financial crisis. The average rate for a 24-month personal loan from a bank, 12%, highest level since 2007. Now you have 43 million people with student loans who, as of this month, have to start making payments. Morgan Stanley did a survey of 2,000 of those people. 34% told Morgan Stanley they can't make any payment at all. That's the bad news. The good news, and this is really important, retail sales, employment, these things are still going strong. So it's a really tough push and pull we all have to just live with on a day-to-day basis right now.
Yeah, we've had so many conversations about whether there's going to be a year-end rally or not. And I know that's on all of your minds. It's on everybody's mind, right? I got to bring in Joe Terranova now. He's not, a regular on the show today, but he's made a big move, and it plays right into that story. Joe, you told us you sold the Qs, which I'm just so surprised to hear from you, because you must have turned bearish on the overall market then between now and the end of the year, because this was the way you were expressing what you have told our viewers for the last few weeks was a way to be bullish into the end of the year. Explain.
No, I wouldn't say that I've turned bullish on the remainder of the year. I think bearish. Bearish, rather. Yeah, bearish. Scott, it's one of those days. So I wouldn't say that I've turned bearish on the remainder of the year. I still believe that if, in fact, we're going to see a fourth quarter rally, it's going to come from technology and communication services. Those are the only sectors that are up so far quarter to date. But let's kind of go back and walk through how I played out the expectation that this would be a strong quarter. I was selling out of IBB, Datadog, Bank of America, Morgan Stanley. Then I turned around and I bought the QQQ. So that was a good move. I was in the QQQ at around 368. But here's where I ran into a problem. I ran into a problem where I tried to defend that position. And I tried to defend the position at a critical point in the market where, as Josh was initially describing, we've got this, what I believe is now a new dynamic from the Federal Reserve, where it seems as though they don't want to quit. So from the perspective of trying to defend the position, I was in the futures market today. I played the futures market from the long side. So you know how that worked out. It didn't work out pretty well. You have to neutralize positions when they're going bad. That's exactly what I had to do at this point, and I lost the right. To maintain a position heading into earnings next week, where I think the earnings could be good, but the bottom line is you're beholden to what your P&L is, and the P&L was absolutely going the wrong way on this trade, and I had to neutralize it.